Hello, everybody. I'm thrilled to be here. My name is Tom Trowbridge. I'm here to speak about DePIN token economics. It's great to be at ECC, at the 9th ECC. This is the 6th one, I think, that I've attended, and thrilled to be back here in Cannes and looking forward to more here. What a terrific place to do this. This talk comes from the DePIN token economics report that I published last year. And for those of you who want to understand more about token economics, I highly recommend it. Obviously, I'm biased, but most reports I've seen on this talk about token economics in theory. This looks at all the tokens, or most of the tokens that are trading the DePIN space, and dives into detail on what seems to work and what doesn't. And so it's a really practical guide to token economics. And it needs to be updated every so often, and there'll be another one coming. But there's clearly challenges with doing this, right? When you're doing a token economics report, there is a whole host of challenges. There's no standard format for describing token economics. There's not even a source. Projects list their token economics on X, on blogs, on white papers. There's a wide range of detail that's shared. And token models, of course, are evolving and get updated. So this is kind of a snapshot in time of what the DePIN token economics looked like at that point. And I welcome feedback, corrections, additions, and I will publish another version of this, an updated version, later this year. But basically, the one takeaway for projects and investors is token economics should fit on one page, right? There's no reason for it to be more complex than that. You have to have a couple key points, like total supply, how the rewards work, what inflation is and how it's generated, staking, how that works, and how the revenue moves to the token. And obviously, very important, the governance mechanism for altering these economics. And the reason why I think this is important is investors value transparency and predictability. And when you have something that's arbitrary and not transparent, you will be valued less. And I will show an example of this going forward. But I think the opacity of our space and the wide variety of how these token economics are structured and even described does a real disservice. And we can zoom out well beyond DePIN, right? This is true across the whole sector. And so DePIN is just taking a very specific frame, but you can look much more broadly than just DePIN. But let's take a quick second, and what is DePIN so we're on the same page? So DePIN is crowdsourced physical infrastructure put together in a network, providing a useful service that's secured and incented by crypto economics. All right, and so this obviously excludes mining. And if it did include mining, then pretty much everything would be DePIN, so it kind of has to exclude it. But that's what DePIN is. And there are two main kinds of DePIN. There's cloud DePINs, which are, think of them as the server-based services that are the Amazon or the Google or the cloud alternatives that do file storage. They do file rendering, like you see video rendering, like Render and LivePeer, and they also do compute, whether it's CPU or GPU compute. Those are really the digital cloud DePINs. The other side are physical, and the physical ones usually involve a use-specific device, like an antenna for something like a WeatherXM or GEOD, or they use very specific applications on other hardware, for example, on your phone. Some of them do that. Layer Drone does it on drones. So there's a wide variety. Demo has a device you plug into your car's dashboard, right? So a lot of different physical devices that collect data and allow services to be offered. And I think those are just an important frame to set what DePIN is. DePIN has been out of favor recently. A lot of crypto has, obviously. But I think it's going to return because DePIN is actually a core enabler of AI. And it's across the AI spectrum. And so you have model construction and training from Jensen and BitTensor and others. These are just some examples. There's plenty more. There's GPU marketplaces, Fluence, what I'm a co-founder of is GPU marketplace. Akash has been around for a very long time. They're a GPU and CPU marketplace, IONET, Aether, and others. Then there's web data, Grass, Scrapes, terabytes of data a day that are used in LLMs. Location, GeoNet gets 1 millimeter specific location, perfect for robotics, very useful in AI. And then visual data. Layer drone uses drones to map the world in 3D far more precisely and more updated than satellites. So these are all core AI enabling technologies that are superior and cheaper than the centralized alternatives. So why is DePIN interesting? Just let's also take a step back for a second. Its global crypto market is obviously, it's down from its peaks, but it's still about 2.4 trillion, so it's huge. Hardware features and pricing are only going down. Like hardware pricing goes down, features are going up. What's available on your phone now was unthinkable a decade ago, and a tremendous evolution from even 5 years ago, from the optics to all the sensors. And then software availability is obviously increasing dramatically. The software sophistication and the low cost and availability of open source has also increased dramatically. So DePIN takes advantage of these three trends, each one of which is moving only in one direction. Crypto is only increasing its adoption. Hardware features are only increasing, pricing is going down, and software availability is only going up, right? So DePIN takes advantage of all three trends, which are going in only in one direction. And what's some examples of the value proposition that DePIN is able to extract from those three trends? There's a wide variety. Here's a couple of them. I mentioned Demo. Plugs into your car, and now Demo is collecting car data and offering services across models and manufacturers that was never before possible. GeoNet has a 1 millimeter specific location, which is 90% cheaper and 100 times more precise than most of its competitors. Helium offers mobile much cheaper. Layer drone maps cities by drone. That ends up being about 50% cheaper, maybe even more, but most importantly, 3 or 4 times better resolution, and it can be mapped, the next day, right? So 10 to 20 times faster than a satellite or even a plane, and it can be done in all weather, or at least cloud cover. So massively superior offering. Hive Mapper mapping in cars, I'm sure you're familiar with that, and Grass is obviously offering web scrape data much cheaper than the centralized alternatives. And so why do we care about token economics? Those are great services. Why do we care about the token economics? Well, it's because we're past the meme stage in crypto, right? So meme stage we've moved beyond that. And traditional investors are moving into this space. There's now about $300 billion of capital from traditional investors from either the ETFs or the DATs. Right, that is maybe 15% or so of the crypto ecosystem. That also is growing. That and we're going to welcome that investor base, but that base cares about revenue and results. And revenue they only care about if there is a link to the token, which is where token economics comes in. Right, so it doesn't matter if you generate a lot of revenue if there isn't a link to the token. Otherwise, it's effectively a meme. And I think we know most of crypto are memes. And that is part of the reason I think we're in a little bit of a difficult period right now. But this is changing as projects generate revenue. When you're looking at token economics, the first thing you want to start with is what's the reward schedule, right? Because this is what generates the kind of token supply overall. So, and there is a wide variety of reward schedules out there. There is no one model, right? Some have a constant decline of rewards like Arweave. Others have a very specific 15% annual decline in perpetuity. Others have 2-year halving, sort of like GeoNet does that, as does Helium, kind of referencing the Bitcoin model. Others have a percentage of revenue, which relates to the rewards, which is also makes a lot of sense. And others are more network-based, and some are just decided annually. And the proposition I have is the more fixed that number is and the more definable it is, the more investors will find it interesting and pay attention to it. If it is arbitrary, you will suffer a discount as a result because investors value certainty and predictability. And that leads to the challenges. Why do some of these token rewards, are they sort of open-ended? it's because they're not priced in fiat. And so people rewarded in an arbitrary number of tokens. That can lead to incredibly high dollar value rewards. And we've seen projects benefit or have a challenge where their providers were paid so much that they didn't actually want to offer services because they were just getting paid in tokens whether there was service on them or not. And then when low token price happens, your providers who have fiat-based costs go out of business. And I think Filecoin is a real example of this, where Filecoin miners did incredibly well in the Filecoin token boom, didn't even care so much about serving real customers. And then in the price fall, had to go out of business because they fell so far they couldn't cover their costs. So the answer here is you really need to have rewards that are fiat linked, so that there isn't an arbitrary token amount that can be worth a huge amount or very little. That's not a way you can build a sustainable business. And DePIN projects are looking for institutional adoption, have real institutional customers, and so the people that are providing that service must be dependable, or else you're not going to get the actual customer base that you need. And you also should be pricing this service, obviously, in a fiat price. You can take tokens, but no one is going to try to budget in some arbitrary token over some multi-year time frame or even multi-month time frame, because it's just not how companies budget. So this link to fiat, as much as some of us may not like that and think it's different than how the industry should work, is really it is a kind of a gating item for success and for growth and sustainability in the space. And so why does this make DePIN different? Well, if you're following those comments and you have the appropriate reward schedule and the ability to attract institutional customers, your revenue, and you're offering a valuable service, revenue grows. And we're going to look at GEOD and Grass, which are two kind of leading DePIN projects, and show kind of their profiles and how they've been doing and what they are, in case you don't know them. GeoDNet is an RTK location provider, so it provides locations up to 1 centimeter. And that's like 1 meter versus is what GPS is. So this is 1 centimeter, right? So it's perfect for farming, for robotics, for all kinds of things. They offer, right, the last time I checked, 13,000 sites for this RTK location service. The nearest centralized competitor has less than half of that. And that centralized competitor took 10 or 15 years to get there. GeoDNet did it in like 3 or 4, right? So it has double the amount of coverage of its centralized competitor. It's 30 to 80% cheaper. That depends on how long you buy the service for, et cetera. And it's a big, it's a $3+ billion market. I think robotics are going to grow that even more substantially. They've generated $8.5 million of ARR as of March this year. All right, this is doubled from a year ago. So they're doubling revenue over the last couple of years, which is very exciting. We're going to see how that impacts the token in a second. But farming and robotics customer is pretty interesting. Now, Grass basically is a web scraping protocol. So you download a browser plugin, and it uses your IP address to scrape data, which it then collects and sells to LLMs. All right, 8 million active monthly users are scraping data for Grass, right? That is a massive scale. And there are no centralized companies that provide it on this scale. It's doing something from, I think, 80 to 1,700 terabytes a day of web data scraping, right? Massive amounts of data. And you guys all know LLMs are voracious consumers of data, and current data is valuable. So this is a pretty fascinating business. Its revenue is 33 million as of Q1, right? So massive amount of revenue for this business, if you're not an exchange, I guess I would say. But here's the interesting thing. We've got these two projects, Grass and GeoDNet. Both, GeoDNet has 1/4 of the ARR. Their circulating supply is about the same in terms of value. And that's because GeoDNet does an 80% buyback. So it takes 80% of its revenue, buys and burns the token transparently on chain. Grass buys and burns, but like 5%, and it's somewhat arbitrary. And so even though one is generating 4x the revenue, circulating supply value about the same. And even though the fully diluted of Grass is about double GeoD, it's nowhere near where it would be based on just the revenue numbers, right? And so I think this is just a little indication that token economics really matter, because you've got a project generating a quarter of the revenue with roughly comparable size, which I think is due to the transparency and faith that an 80% buy burn does. And so buy burn is used by a large number of projects, Helium, Glow, et cetera. GeoD bought $1 million of its token back in Q4 of 25 as an example. But these projects use it. Here's a buy burn percentage. Glow buys and burns 100% of its revenue. Render buys a lot. GeoD does as well. And then you can keep going down the spectrum. And so token economics link revenue with traction. Now, marketplace ones can't do buy burn, because if you run a marketplace, you're basically giving money from customers to the suppliers, and you're sitting in the middle taking a little fee. Much harder to do buy burn at scale. But you need stake and rewards. And so for these cloud DePINs, stake is used as a way to generate trust. So when you get these third-party servers and you don't know who the provider is, they stake on those servers. And that's how you know that you can trust them, because they'll get burned or won't be able to earn revenue if they do not perform. And so as the project scales, the stake required scales, and that is the basically token scarcity driver, which we'll see. One important point is you should allow not just the providers to stake, but anybody else. And early stage DePIN projects required their providers to stake, and that was it. That's not optimal. It raises the cost for the provider. They have to buy the token to stake it. You should have investors be able to stake on the providers. Those are often very different universes, so it makes sense to basically have an ecosystem that includes both. And so as an example, Fluence is a case study here. We are a GPU platform. Institutional users connect for low-cost GPU usage. And payments via stablecoin, there's a small fee to Fluence, and trust is via staking. And so that sounds attractive. How does that play in token economics? Well, revenue is passed to stakers. And so as an example, if we get 10 million of revenue, that's about 500, that would be about 500,000 of revenue to Fluence. That's about 1 cent to the amount of tokens we have staked today, right? Our token price is like half of a penny. So if we did that, it'd be about 130, 150% yield. And the only reason I mention this 10 million number is I'm pretty confident that we're going to get that in the near future. Now, not all of that will be passed on to token holders. We have OpEx and to cover as well. But that gives you a sense as to how these models can scale. At 100 million of network revenue, that's 4 million of payments. That's, at the similar numbers, it's like 3 or 4 cents at 3 cents a token, which dwarfs the token price. So if we can scale, this is pretty powerful upside. There's others that do lottery rewards. If you have lots of small users, you need to actually incent them more than you can pay per device. So lotteries are an interesting way to do that. So I think these are examples, Silencio, Huddle, Natix, where they have thousands and thousands or even millions of phones, and you can't pay each of those phones enough to be really worthwhile. So every month people are entered into lotteries to win, and that keeps people excited and interesting. So suggest that this is the model I think works. You accept fiat, you business customers, stake rewards, you buy burn at a higher rate that's predictable. That's interesting. And you, on the rewards, you fiat link. And this is why I think DePIN wins, right? You've got services in critical markets like enabling AI. You have live networks, products that are working, that are cheaper and provide value. And you add that to powerful token economics, and you have the next generation of crypto. And I think that is where we are with DePIN. And I think AI is going to, and the DePIN together are going to accelerate and really be the future. So that's why I think DePIN is not a meme. And there were times when I think we kind of wished we were meme-like. I think now we're okay not being, and I kind of miss some of the euphoria of the meme age. But I think important to realize this is real business that's working and doing incredibly well. So take another look at the DePIN token economics report and look at DePIN, DePINspace.co. We've got a podcast with about 100 DePIN founders there if you're interested in the space. And we also do DePIN days. We've done, I think, 13 or 14 DePIN days with leading projects. But depinspace.co is where you'll see that. And here's the DePIN token economics report. So thank you very much for your time.